Today, we're diving into something called an Employee Stock Ownership Plan, or ESOP. It's this really powerful way for a business owner to sell their company, but it also creates a pretty unique kind of financial risk for the employees. So we're going to break down how they work, who really benefits, and this is the important part, what you need to know to protect yourself.
All right, just imagine this for a second. You've poured 30 years, your whole life really, into building a company from scratch. It's your baby, but now you're ready to retire. So what do? Your options kind of feel, well, limited. You could sell to a competitor, but they might just tear it apart. Or maybe you sell to a private equity firm, but then that amazing company culture you built, poof, probably gone. It's a really tough spot to be in.
But what if there was another way? A path that actually rewards the very people who helped you build this thing brick by brick. That's exactly where the Employee Stock Ownership Plan comes into the picture. It's a completely different way of thinking about it, one that puts the company's future right back into the hands of the people who know it best.
So let's get right to it. What exactly is an ESOP? It's way more than just a way to sell a business. It's actually a special kind of employee benefit plan that can totally transform a company, both financially and culturally. Okay, so here's the official textbook definition. A few key things to pull out of there. Tax qualified means, you guessed it, big tax benefits. Defined contribution is just a fancy way of saying it's a retirement plan. But the most important part is that it invests primarily in the stock of your own employer. And this is huge. The company is the one funding it, not you from your paycheck.
You know, the easiest way to wrap your head around this is to think about a 401k. Most of us know what that is, right? It's a plan that holds a whole bunch of different investments to spread out the risk. Well, an ESOP is different. It holds pretty much just one stock, the company you work for. And that one simple difference, well, it's the source of both its greatest power and its biggest potential danger.
All right, let's get into the nitty-gritty. How does a company actually put one of these together? It all starts with creating something called a trust, which is going to act like a middleman to buy company stock for all the employees.
So there are basically two main flavors of ESOPs. The first is called a leveraged ESOP. Think of this like the company taking out a big loan to buy a huge chunk of its own stock all at once. The other kind is non-leveraged, which is more of a pay-as-you-go system, where the company just contributes cash or stock over time.
This diagram here shows you that simpler, non-leveraged way. It's pretty straightforward. The company puts money into this ESOP trust. The trust then uses that cash to buy company stock. And then those shares are held in the trust for the employees, and they get divvied up into everyone's individual retirement accounts over the years.
Now this is where it gets really interesting. Because when an ESOP is set up the right way, it's not just a win-win, it's a win-win-win. There's some serious perks for the person selling, for the company itself, and of course for the employees.
I mean, just look at how the benefits spread out. For the owner who's selling, they suddenly have a buyer ready to go, and they can even put off paying capital gains taxes, which is a huge deal. For the company, it gets massive tax deductions. And for the employees, well, they're getting retirement savings without paying a dime out of their own pocket, and they now have a real, direct stake in the company's success.
Yeah, this quote from Live Oak Bank really nails it. There's this massive cultural shift that happens. All the data shows that when employees actually become owners, their engagement goes through the roof. It changes the whole mindset from just working for a paycheck to working for our company.
Okay, but it's not all upside. Becoming an owner isn't just about the potential rewards. It also means you're taking on a new kind of financial risk. And that brings us to the other side of this ownership coin. We've all heard that saying a million times, right? And it's so true here. Owning a piece of the company you work for feels great. It's empowering. But it also means a huge piece of your retirement, your nest egg, is tied to the fate of just one single business. And this leads us to a really critical idea in finance.
It's called a concentrated position, and by their very design, ESOPs create this situation. The rule of thumb is that if more than 10% of your total net worth is wrapped up in one stock, your portfolio is now super exposed to risks that have nothing to do with the overall market.
This chart right here is a perfect picture of that risk. The blue line is what happens when you invest in just one stock, in this case, General Electric. The red line is a diversified portfolio. And the difference is, well, it's night and day. The single stock is this wild, volatile roller coaster that ends up lower, while the diversified portfolio is a much smoother ride up. It's the classic, don't put all your eggs in one basket story.
And don't think that GE example is some rare, one-off thing.
Research going all the way back to 1980 found that over 40% of all companies in the Russell 3000 index had a catastrophic loss. We're talking a price drop of 70% or more that they never recovered from. That is a really sobering thought if your retirement is riding on one single stock.
So this is the crucial question. What can you do about it? The good news is there are actually rules and strategies designed specifically to help employees deal with this exact problem as they get closer to retirement.
The law actually gives you what's called a right to diversify. Here's how it works. Once you hit age 55 and you've been in the plan for 10 years, you get the option to start moving your money out of the company's stock. You can move up to 25% of your balance into other investments. You can do that for 5 years. And then in that final 6th year, you can move up to 50%. This is an absolutely critical tool for lowering your risk.
And smart companies often do more. A lot of them will pair their ESOP with their traditional 401k. By making sure the 401k investments are more conservative, more bonds, more stable stuff, it can act as a kind of counterbalance to the high-risk nature of the ESOP. It helps create a much more balanced retirement picture overall.
Look, there's no doubt ESOPs can be an absolutely incredible thing. They build wealth, they save companies, but for the employee owner, they come with a risk that you have to take seriously. And it leaves us with a question that honestly we should all be asking ourselves, ESOP or not. When you look at everything you've saved, is your retirement basket really ready to weather a storm?
This is not financial advice.